week. We just got through OPEX, but there's still a lot of gamma left. Today we're looking at retail sales. We have some Fed speakers on the agenda as well, and additional auctions at lunch. So a very busy day in the market. These are my own local time zone. So it looks like Miser's going to be speaking at noon, not 11. And Barkin will be speaking at 15:30, not 14:30. As we usually do, we want to look at the Europe market wrap, just kind of see what's going on over there right now. You got to remember, that the market's still open over in Europe. If we were to scroll back far enough, there would be an Asian wrap, and that would kind of give us an impression of what happened over in the Asian markets. There's a lot on the table right now. A lot of indicators are pointing to the low being in on the market. And yet there's still most analysts saying that we are not done. This is not the low, and we've got a long ways to go. I just noticed Barkin is on there twice. He's listed up here at 11, and then again. Now, sometimes they'll make the rounds. They'll run the circuit. On Sundays, there's a thing called doing the Ginsburg, and that's where they go to every single media outlet on a Sunday and hit all the outlets with a single message, and it's called doing the full Ginsburg. This seems to be some muted version of that. Remember what we've said before, when more and more and more people seem to think that we should go down, it's time to start looking up. A lot of contrarian indicators look at how much investor confidence or investor sentiment is positive or negative. The more positive it is, the more we expect to see a market pull back and start heading to the downside. And the more negative it is, the more we expect to see a market flip and start running to the upside. But when it comes to those contrarian sentiment indicators, we are pegged out into some pretty extreme levels. And yet we've continued to go down. When I was looking at some of the pair ratios, say for something like the S&P, just to kind of demonstrate their effectiveness, in the later part of 2021, when the S&P was trying to slowly grind higher, kind of running into that apex, the pairs ratio was divergent and headed to the downside. Right? So, there's a lot of reasons to suspect that this is a generally accurate tool. Well, in the current conditions, it has a higher low and it's pointed to the upside, whereas the market has set a lower low and is pointed to the downside. So should we trust it? It's not really about trust, right? These indicators, they do what they're designed to do. They measure something. This is indicating, or it is divergence. There's no arguing with that. It is divergence. Is it right? Will this be the low? It's hard to say, right? But we always want to recognize when there is new information, and this is new information, right? So just pointing that out. It doesn't really change what I've been doing on a day-to-day basis, but if you're looking at dividend stocks or maybe some longer term buy and hold stuff, and you've seen a lot of names on sale that you wouldn't mind owning, as long as you're not averse to a little bit of pain, buying along the lows is always a good idea. But you're gonna feel some pain, right? You get in early, and you're gonna get cut up a little bit. That's the way that the ball bounces, right? Okay, for the week, it really does help when we start out for the week if we look at the weekly expected move and we kind of get a gauge or a feel for the size of the expected move this week. Remember, it's a short week, and yet the size of that expected move box is a very large box, right? If we were to just put it into comparison, how large is it compared to last week's? It's bigger than last week's. Last week measured an entire week, 5 days of market action. This week is only measuring 4 days, and yet it's bigger, right? So they have priced in more volatility for the current week that only has 4 days in it than they did last week that had 5. Also, keep in mind that we are sideways and we are inside this major controlling candle. Now, when we're in an inside day pattern, a very small candle is something to get excited about, right? If we were stuck inside of this little candle down here and then we ran sideways for 4 or 5 days, oh boy, that'd be one heck of an explosion when we finally came out of it. But instead, we're stuck inside of this really big candle here, and that doesn't hold the same amount of validity, right? So if you kind of count back, the futures were open Sunday night into Monday for a brief period. So that gave us that little candle. And that candle was inside of Friday. But we want to wrap those two together. And a lot of analysts will do that. And um, so will the broker platforms, right? So we really just consider that one day. And that since then, we've been moving in this single candle here, but we're still inside day breakout from Friday. The upside target, if we were to continue to move today, is going to be that very large candle or the top of the weekly expected move, which is 37.95.5. It's a lot of fives. 37.95.5. All right, so let's look at the ADR, average daily range. The top side ADR is 37.85. The downside is 35.82. If we were to do half the ADR, it's 37.38 to the upside and 36.33 to the downside. We've already gone half the ADR. The S&P is up 1.71%, and we have an ADR of 2.7. So we could easily make another 1% move and match our ADR for the day. Just keep in mind, the ADR is the norm, right? And we're always looking for things above the norm, things that have exceeded its expectations. So with that in mind, we do want to continue to keep our eye on the 37.85. Now, there is a trade setup that I've often referred to, and it first has to fit into what does a normal market do? Kind of think of the daily chart time frame. If we had a market that was basing along its lows and it wants to start moving to the upside, we would see something in a trending form like that, right? Because the market doesn't just move straight up. Well, on those pullbacks, it often comes from seeing a market run to the upside during the day, and then in the overnight hours, we get that fade back, come into the open, we drop down even lower, and then after a good 30 minutes or so, we continue that run to the upside, and we close the next day higher than where we opened, right? And it just continues to set those new higher highs and higher lows. Well, if you flip everything over and take it the other direction, what you often get is a rally in the Globex, kind of come off a little bit as we come into the open, rally up, bump our head against the top of that Globex, and make our move to the downside. We're going to continue to look at today as if it was a Monday. When you're thinking about price discovery on a Monday after a weekend, you have to let price discovery happen, right? There's all this news that needs to be priced into the market. There's an old Dow logic that says everything you need to know is already priced into the market. That's why a lot of traders say, like Resnicek, Peter doesn't use a lot of news, right? He just looks at the candles because everything you really need to know is priced into the candles. An argument could be made for and against, but either way, when we come into the start of the week, any news that has not yet been priced in needs to be priced in over from the weekend. So we've got two things sitting on the table. One would be the idea that we could open and rally right into our own Globex and then reject there. It should be something like 10, maybe 10:15 in the morning that we hit that rejection point and we continue to move to the downside. That'd be one argument, right? But before we even get to the open, there is still some more econ on the table. We could re-challenge and retest and break out of that to the upside. So this is a linear regression drawing tool. It will center that line. We just tell it where to start and where to stop. And what we want to focus on are these swing lows and these swing highs. So we've set a swing low. We failed on that breakthrough, that breakover from the last swing low. We had a swing high, swing low. We're looking for a new swing high. If this is going to be the new paradigm, moving into this very muted, shallow area where the swings are much, much tighter than they were, then we're on track for the next rollover, right? Instead of using the peak from where we were, instead using that consolidation pattern right before the Fed. If we were to use that as our basis and our starting point, then there's our swing low, swing high, swing low, swing high. There's been a lot of discussion that in the next few days, we're going to see a significant repricing in the market. The GEX and the gamma that was left over from OPEX, they're looking to wipe that out. So if we were to see a significant break to the downside and say hit 33 or 3200, that would reset and reprime the market. So I've heard some people say, no, we're going up from here. And others said, no, we're going down from here. Like a good lawyer, you should be able to argue both sides, right? There's almost always enough information that you can make the case for a long argument or for a short argument. That's generally the way it goes. In a high volatility market like we're in right now, both could actually be right. We could go to the upside after making a significant liquidation break to the downside. So we just want to start with focusing on our levels, identifying key areas or benchmarks that would begin to validate that argument that we're going to continue to move lower or that we're going to continue to move higher and trade what we have, right? So it kind of comes down to that old question, hey, do you think we're going to bounce at this level? Doesn't matter if I think we're going to bounce at this level. Let's just see price get to that level. And if it starts to bounce, we'll trade the bounce. If it gets to that level and breaks through it, then we can trade the continuation to the downside. I don't have to think about, do I think it's going to bounce there or not? Right? Because nobody cares what you think. It doesn't matter if you think it's going to bounce there. You just want to know how we can make money on it. We are already inside day breakout. And like I said, we're not going to really focus on Monday. We'll price that in with Friday. So with that in mind, Friday's levels is the level that we want to focus on for the inside day breakout. But that still leaves us inside of Thursday's price action. Like we talked about before, break that down into different zones. The Globex high of Friday and the Globex high of Thursday would be one zone. And then all of Friday from its Globex high to its RTH low, that would be the second zone. Now, if you want to break that down even more, you would break it down into our Globex high of today's range and Thursday's high. And then from our Globex high to Friday's high. That would give you 3 quadrants instead of 2. All right, so we're looking at a 10-day, 30-minute chart. We have a significant level of volume over our head at 3770-ish, right around in there. Should we get through that, the volume profile turns very shallow, right? We should be able to move through that area relatively quick, all the way up to 3,900. It's important to recognize that this pivot point back here, the top of that box that I drew at 38.33, this is why we look at the volume profile. At any other point, or when I was newer, I would have drawn a line there and said, oh, it's an institutional pivot point. I bet that's an area of resistance. When we get there, we're probably going to struggle to break through that line, but there's nothing there. It's not going to pose a significant level of resistance, or at least it's not likely to, right? We don't want to say that it can't. We don't use that kind of language, but it's very unlikely to be a level of resistance. So if we get that high, we're very likely going to punch right through it with conviction. The danger area, or the area where we're going to have a large struggle, is where the TPO's point of control is at. And that would be the blue profile here with the red line. That ties in with this very large volume profile, 3770. Right? So if we can get through that 3770 zone, it should be smooth sailing. I'd like to say it would be downhill from there, right? In the consideration that there would be less and less and less volume resistance. There is more volume at 37.27, 39.27, but that's so far away, I find it very unlikely we're going to tag that level today. If we were to think about moving to the downside again, that volume profile is underneath us at 36.75. We would expect that to provide some support, not like a handrail that we would want to lean on. We don't want to give it that much trust, but we would anticipate a significant level of reaction in the market should we come back down to that level. Then breaking that double bottom low, and what things would just really start to get nasty after that. All right, so looking at the volume profile here on the 5-day, 5-minute, call this mapping out the 5x5. There is a point of control back here, but it's not an untouched point of control. We already hit it, right? We passed through that on the way down a few days ago. So there really isn't a lot of validity to bring forward any of these volume profiles. If we want to bring forward an untouched point of control, there's yesterday's, which, like we've already talked about, we wouldn't really count as its own day, but that is a volume profile with a point of control, and it is untouched at 3,700. So if we were to begin moving back down in that direction, we would be focused on 3,700, providing some form of support and or reaction out of the market. So what's the dominant thesis for the day? Well, when you look at everything that we have on the table, keep in mind we got Fed speakers 3 different times, and we have additional auctions at 11 and 11:30. It's expected to be a very violent day, and the best that we could hope for is that it picks a direction and just sticks the move, right? That it picks one way and just runs it. And we call those a trend day if we are outside of the previous day's price action, and we are, right? We're already outside of Friday's price. So with that in mind, we've already met half the criteria for today to be a trend day. When you can validate a trend day before the market opens and lean into it, you get another chance to take another bite at that apple over and over and over and over again. It'd be a day like this, for an example, where it was just one time framing, single market direction, nobody taking the other side of the trade. Right? And that's exactly what we want to see. So a very, very high correlated market state, something like the AD pushing at 85, 95. And that would be on both indexes, NASDAQ and S&P. We want to see the ticks hanging out in the green, the cumulative ticks pointed up like a rocket ship. We don't want to see any curling over in the Russell or the green line in that cumulative tick. So AD, UVol, tick trend. Preferably, we want to see the dollar slow down and calm down. We were starting to get a little bit of a liquidation break in the bonds about 30 minutes ago. Right, so we've got that megaphone pattern happening here with the dollar. That thing needs to calm down. And if it does make a significant break, we want to see that break to the downside. But that's a falling wedge, and so we're very likely going to see an upside break out of a falling wedge. Notice the VIX, though. It's been really, really tight. It's just barely starting to perform a bit of a megaphone pattern. The main thing is that we don't want to see that get back above the $31 level, right? If we maintain below 31, we can maintain a bullish move in the S&P and the NASDAQ, which as I'm speaking, we're breaking down a little bit more, giving back some of that move, right? Oil's been pretty much range bound, holding underneath its VWAP for the Globex session. Bonds are back down to their low with that micro double bottom. Gold had that micro double bottom, but lost its support and started breaking to the downside. And we continue to watch Bitcoin. Now, I've had a lot of people say, well, Bitcoin's not a correlated market state, blah, blah, blah. We're not looking at it for a correlated market state. We're looking at it for what it is, a very risky asset. If you haven't tried to price or trade Bitcoin futures, they're crazy, stupid expensive. Like you got to have some real size if you're going to trade into that Bitcoin futures product. And there's two ways that a product like the futures can be traded. You've got the basket of stocks that make up what that futures represent, and then you've got the futures themselves, right? If we weren't thinking Bitcoin and we were just talking about ES futures, we would be thinking of something like the S&P 500 and all of those companies that make up the S&P 500. The algos can trade the basket of stocks and literally bid into every one of those companies, and or the algos can just trade the ES futures. So when you see Bitcoin moving around, it literally implies that institutions or firms or large traders are in a risk on or risk off sentiment, because that thing is pure speculation, right? It's a very risky asset. And if they're buying into that or bidding up in Bitcoin, then we're in a risk on environment, right? So it's not about trying to match a correlated market state between the ES and Bitcoin. It's just recognizing that Bitcoin is a super risky asset. And then when we see it bid up, that the mood or the sentiment or the zeitgeist or the animal spirits, or put it in there however you want, we're in a risk on sentiment. With the additional auctions, they never show up. If you were to go to FX Street or Econo Day and you look at the lunchtime auctions, they never represent as an impactful economic event. They're always like this afterthought, if they're even mentioned at all. Oh, yeah. And by the way, we have that 4-week bill announcement, or we have that 3-month auction. And yet, I look at those every single time we have one as a significant opportunity. One of the greatest skill sets I've been able to pick up is catching V bottoms off the midday and running the market up off of those lows. I don't get it right every time. I don't think anybody gets it right all the time, but I've certainly called bottoms and V bottoms on an intraday basis way more than I statistically should be able to. And it's from nothing more than recognizing that we had an additional auction that day, watching the clock and looking for that 11 o'clock break or the 11:30 break to the upside. Right? There's no magic to it. So when we have these, you want to pay particular attention to them. Watch the clock at 11 o'clock. Watch the clock at 11:30. There's usually one other one that comes in and it's at 1 o'clock. Right? We don't have the 1 o'clock one today. We were in a risk on market this morning. Obviously, that's starting to unravel a little bit. So you're going to want to redo these steps as we get closer to the open, right? I have to do them early enough to be able to run the streams and then get other things done. But it would be better if you were to take these practices that we do every day, right? Because we do the same thing over and over and over and over to teach you guys how to do the same thing. It would be better if you take this and practice it as we get closer to the open, right? Go through the steps yourself. Work on these same features and same characteristics. Trust me, you're not going to get it right away. It took me a couple of years to put together my morning briefing in the way that I perform it now. But you guys got something that I didn't have at the time, right? You got me doing it every day, kind of walking through the steps. When I was putting all this together, I didn't have that as a guide or as an example. I have done a video on what I'm about to bring up. This will help you go a long ways. It's a trend day checklist. And it really needs a better name, because when I built this checklist, it was designed to catch one of those 4 trend days, catch them before the market even opens, right? Knowing that we could have one of those days before the market even hit the cash session. But that was a different time. It was a different market. We're not in that kind of market anymore. One of the key characteristics of catching a trend day before the bell is volatility. And every day is volatile now. So that doesn't really help, right? But these metrics, having a daily structure, a nightly plan that you do the same thing, you build a routine and you follow that routine through. Obviously, you can make it as extreme or as light as you want it to be, but you just go through that checklist every day. Where's the volatility at in this market? What did the market do today? What's our next levels of support and resistance? Taking the time to go out to the daily, the weekly, the monthly. I know those charts may seem worthless if you're an intraday trader in the futures, but there's a lot of value out there. There's perspectives that you would only get by going to that chart. And maybe you go out there and you don't see anything. Okay, it doesn't promise you anything. But what if you go out there and you actually do find something? All right. So if you never go, I promise you'll never find anything. Putting together your own checklist, um, it's not that bad. Like I said, I've done a video on this. It's on the Bullish Bears YouTube page. So if you were to search on YouTube, Bullish Bears Trend Day Checklist, you'll find the video where I kind of walk through these steps. You want to put together your own thesis, right? You're looking for a narrative in the market. What do I think the market's going to do today? What's the dominant thesis or the dominant plan? And then make the alternate thesis, right? Because some of the biggest moves we've seen in the market comes when we catch everybody off sides. If everybody thinks that a double bottom is going to be a spot to bounce and then we don't bounce, just for an example, then everybody who gets squeezed there thinking it was going to bounce drives the market into these explosive, exaggerated moves. So when everybody, quote, everybody thinks we're going to do one thing and the market does something else and we catch them off sides, it isn't the idea that, well, you thought we were going to go up and we went down. You were wrong. Think about it from the idea of how many other people were wrong. Was it a very clear and convincing and obvious signal that failed? Then it probably caught a lot of people off sides. So you have your dominant thesis and then your alternate thesis. If A, then B, right? So kind of approach it from that point of view. When we get closer to the open on a day like this, reevaluate these same steps. What are the futures doing? What are the bonds doing? Oil, Bitcoin, the dollar. Start looking at the sectors. Now, I think Thinkorswim doesn't do a really good job when it comes to the sectors in the pre-market. We're talking about change percent, what we're looking at right up here on the ES. Because it's the futures, Thinkorswim is showing us change percent. But if we were to go over and look at something, say, like Apple, it doesn't show us change percent, right? So Thinkorswim doesn't do a really good job when it comes to change percent, especially in the pre-market, right? So we're handicapped by that. Now, it doesn't mean that Thinkorswim doesn't have anything. It does. It's got these different tools. You use something like Use the News, and you can see pre-market movers. But one of the easiest ways to deal with pre-market movers is to put them in their category of change percent. And it's just like a default simple thing to do. And if we can't do that, then looking through 127 names would be an exhausting, time-consuming search. I'm not really interested in doing that. So at this point, we just step away from Thinkorswim and we go to someplace that will allow us to work with pre-market names and numbers. We do have a red to green on semiconductors, by the way. So if we consider where we closed on Friday, with that really long recovery tail down there. And then we've gapped up significantly in the pre-market, and we're getting really close to where we opened on Friday, which is one of those key levels that I like to watch if I'm going to trade a red to green setup. It doesn't have to get that far, but I like it to get that far. That way, if we start to fade back at the open, our support would be the open from Friday. So we got that red to green setup, and we're outside the boundaries of that Bollinger Band. Maybe that's not a Bollinger Band, right? It looks a little bit like a Keltner channel. Yeah, let's see what we got in there. Yeah, it's a Keltner channel. Okay, so we're outside the bands. When we are outside the bands, we expect the market to get back inside the bands. So we've got a red to green setup. We got an inside day breakout setup. We got a little bit of a bear pennant failure setting up, and we are outside of the Keltners. It's always good to be able to put that and in there, right? Like I got a moving average crossover, and we're above the 50, and we're at a head and shoulders, whatever it happens to be, right? The more times you can add the and to it, put more stack all of your signals, right? If today is a trend day, then almost every single sector is going to go up. All of your markets are going to go up. And at that point, you're just really going to want to focus on the higher beta names, right? If the S&P moves 1% and you find a 2 beta name, it's going to move 2% for S&P's 1%, right? So, the S&P right now has a 2.5, close to a 3% ADR. If we move 3% in the S&P, and you're focusing on a 3 beta name, you could see a 9% move in some of these markets today. So kind of keep that in mind. If this is going to be a trend day, it'll be across the board, right? You won't really have to go in and try to be exacting in your hunt or your pursuit for what to trade. Everything will be moving in that direction, right? So it almost becomes too much. Rather than having 2 or 3 really good names as we come into the open, you're going to have, if we continue with this bullish move, something like 75 or 80 names all making that move at the open. To avoid getting washed out by all of those, right? Just having like too much. Get strict with your criteria. For an example, do the options fit the cost ratio that you like? Does it have enough strikes? How's the liquidity? What's the bid ask look like? What about the beta, the fast beta of the company? Try to narrow down that list by being much more strict in your trade criteria, right? So, like Apple is considered just about as good as you could get on the equity side of things when it comes to options and liquidity. We're looking at a 15-cent or a 20-cent bid ask spread. And if you go far enough out in time, you start getting into $5 wide strikes, right? Sure, we got some 2.5s, but mostly $5 wide. If we were thinking of day trading and stepping into the smaller time frames and getting closer, now we're looking at $1 wide strikes. Well, $1 wide isn't that bad. And we're still looking at around 10 cents in the bid ask spread. That's not bad either, right? In the current market environment, that's not too bad. It has a fast beta of 1.2, so it'll move just about 0.25% more than the S&P will on a percentage to percentage basis. So not bad. Microsoft's basically got a 1 beta, so it'll move percentage wise like the S&P would. $2.5 wide strikes, 30-cent bid ask spread. You can see how much more sloppy that is compared to Apple. Obviously, there's nothing wrong with just trading things like SPY. There's a reason that a lot of people trade SPY. The bid ask is really, really tight. $1 wide strikes. got a lot of choices, right? But it is how we calculate beta. So it's going to be a 1. So we're looking at Tesla here. Tesla's got a fast beta of 2.07. This is likely to move 100% greater than SPY would on a percentage basis. So if SPY is to make a 3% move today, this could easily make a 6% move today. Right now, Tesla has an ADR, average daily range, of 6.8, and it's got an additional market maker move of 2.3%. So you're looking at well over a 9% move if it was to hit its ADR and make the additional market maker move. So as you can see, we've already got that breakout. What you're going to want to watch for as we come into the open is that it does not break back below Friday's high. It's kind of the line in the sand. We'd much rather see it pull back and hold that as a line of support than break through it. Right? We don't want to see it break through and close below. On the close below, I've had people ask, well, what time frame are we looking at? Is that a 5-minute close or a 15-minute close? I'd say I like the 15. I wouldn't go below a 5 on that though. If a 1-minute candle was to go down there and then close below and then rally back up, well, you would have gotten faked out. So at the very least, call it a 5-minute candle. If you get a 5-minute candle close below that level, then you would want to have a little bit of concern. I like the 15 for that, for even using that kind of language. I like the 15, but there's no magic to it. We do want to think about, if today is going to be bullish, where are we going? What strikes do we want? How far do we think this market could go? And is it just a 1-day rally? We're still in a bear market. Bear market rallies are some of the biggest up days in history. So on a day like this, it is primed to have a significant move. At the very least, try to focus on look left properties, right? There's a candle from 615, and the close of that candle is very close to the round number, call it 700 flat. So if we were to get a continuation of this breakout, then $700, it's only $50 away. That's well within the ADR when we bring in the market maker move. We're not reaching too far to say 699 or even all the way up to 710. Right? Because if we can get entirely outside of that 615 candle, then we would have crossed through the 10 and through the 20, and we would have broken out of that downward range. We'd have a TRB setup, and we would have an inside day breakout, right? Or an IX10. We already got an inside day breakout. So TRB, IX10, inside day breakout. Being able to say and on each one of those, right? Stacking the confluence. If we were to come in and take a look at these options, they're pretty sloppy. It's bad. And I know a lot of people, they just trade Tesla. It's all they trade day in and day out. Hey, great for you. I'm glad that you pick a product that you like. But look at the bid ask spread in here. And yes, the market's closed. I realize that. So, it was closed when we were looking at Apple too, right? It was closed when we were looking at Microsoft. And so having that as an excuse and being able to say, well, it's a really wide bid ask spread, but the market's closed. Yeah, it was closed on all those others and it wasn't that bad. Having this really nasty bid ask spread doesn't mean you're going to lose. We just got to recognize that if you were to continue to trade something with a really wide spread like that every single day, and you're market ordering in and market ordering out, not trying to split the mid and catch the middle, land on the mark, then your slippage is just absolutely crushing you and you don't even realize it, right? If that's the kind of trading you're doing, and say you're new to options and you just haven't quite grasped how much that is ripping you apart because you don't see it as a loss. It's not like you have to pay that up front, that there's some dollar value that they're waiting for you to meet before you can have that trade. That's horrible slippage. Add to it $5 wide strikes, not $1 wide, not even $2.50 wide. So you have a lack of choices, and you've got a really extreme bid ask spread. If you could avoid Tesla and trade something else, probably wouldn't be a bad idea. NIO, for an example, has 50-cent wide strikes and 8 cents slippage. Now, obviously, you get what you pay for. This thing doesn't even have a beta of 1. And, it's got an ADR right now of 6.8, 6.4, right? So that's not too bad. This thing could easily, percentage wise, make the same kind of move as Tesla could make, a 6% move. You're not going to make as much money trading a $20 product as you would making a $700 product. Common sense, right? But if you're newer to trading and you're struggling with the options trades that you do make, quit trading the hard ones and trade the easier ones, the ones that aren't already handicapping your position, because it's hard enough to trade anyways. But when you're trading the most difficult ones that are starting you out in a negative position with your hands tied in a handicapped spot, and then you lose, don't be surprised. All right, so let's wrap it up. Take a look at the sectors. Bitcoin, that new BITO ETF. Energy, airlines, oil. Small caps are looking good with the IWM. Semiconductors, which we already talked about. Emerging markets, which is another one of those risk on, risk off gauges that we use, right? It's like a global risk sentiment gauge. When we see emerging markets bid up in the morning, then we carry that uh, risk on bias from the global market into today's trading session. Industrials, technology, finance. Now we've talked about it before, but it's worth saying again and again. When we're looking at the sectors in the morning, we want to pay particular attention to which sectors, because we need either finance or technology. It always has to be one of those two. If we can get both, that's great, right? Because then we're running at a very, very high correlated market state. But we need one or the other. The fact that they're not up extreme, that's not necessarily a bad thing. I don't want to try to go long after we've already made a 4% move in the pre-market. But on the other hand, the fact that they are only, and I hate to say only there, but they're only up 1%, we could easily just continue that trend that I was talking about, where we gap up in the pre-market, we make a run towards the Globex high, and then we leg down and set a new low on the day, and we close at a lower level than we closed the previous day, right? Setting new lows and new lows and new lows. So if that's going to be the pattern, the fact that we're only up 1% kind of fits. And the fact that we are off of those Globex highs fit. We always want to look at the opposite of what everything else is doing. So if the market is up in the pre-market, what's not up? Gold, bonds, natural gas, silver. I like to break these things down into sectors that aren't covered by the legacy 11 sectors of the S&P, and crypto happens to be one of those. The names on this crypto list came from the Smalls Exchange. It is the basket of stocks that make up their crypto product. So some of these are just companies that are heavily vested in blockchain. Some of these are companies that own a lot of coin, and then some of these are coins. Right? Kind of try to have a smorgasbord of different products in there. Either way, we are fully risk on. A few that have not really quite moved around at all yet, but otherwise, we're in a highly correlated risk on market state within crypto. Take a look at the chips, every single name on the list. The EV market this morning, sure, there is a standout, Renault. But for the most part, we are fully risk on. Even the older legacy names like GM and Ford are up this morning. And then the pot stocks. Now, the reason that we go through these extra steps is because that these things we were just looking at, they're not well represented in the S&P legacy sectors. No, there's not a lot of coordination. It's not like they're all hanging out together, chit-chatting in a chat room and sharing trade ideas, right? Consider the overnight traders mostly firms that are around the world, right? Like in Europe, it's lunch. It would be a lot of European firms. So we're in a highly correlated market state this morning, everybody. We're looking at a risk on start. Just keep your eye on finance juice, right? Look for them to update the market wrap. I've seen them do that a few times. Keep your eye on who's speaking today and what time it is on the clock. We do have additional auctions today at lunch, so look for that midday reversal. Otherwise, we're going to just continue to focus on that risk on sentiment as we come into the open. Remember, it's the dollar and the bonds. Now, when we talk about the S&P and the NASDAQ, we make that distinction between the S&P having financials in it and the NASDAQ 100 not having financials in it. So the fact that they're both up this morning really points us to the idea that it's not the financials that are carrying us through the market here. It's probably more tech. And I don't like to say probably. I want to be able to point to something and say, oh yeah, look, it's tech, not finance. TradingView does a really good job of being able to make that statement. Their stock screener does a really good job in the pre-market of being able to break those categories down so that we can say how many names in the S&P are up at least 0.5% or 1%, and out of those, what sectors or subsectors do they belong in? If this is going to be a bullish day, all your sectors are very likely to be bullish, but we don't want to focus on something like XLI that's going to give us 0.5%, right? We want to focus on, say, technology or finance, something that can give us a good 2, 3, 4% move. And on that question from YouTube about pushing the market up, it doesn't even have to be some algo or firm of traders that pushes the market up. All they got to do is have one of those Fed speakers show up on TV and start chipping his teeth about lax monetary policy, and we'll see the market bid up. Right? That's something that used to really frustrate me when I was newer, that I couldn't quite grasp the logic of, well, how did they quote they move the market? How do they make it go up? How do they make it go down? How could they spend that kind of money to literally drive the market and make it move somewhere? And that's how I saw it, right? Like that somebody had to go trade it to make it move. But that's absolutely missing the point. All they have to do is go out and act dovish or say the right thing on TV, and this market would spike to the upside and run like a mad demon. If on the other side of that, they want to knock it down, all they got to do is go on TV, chip their teeth, and be more hawkish, and they're going to dump this market down. The plunge protection team was literally built and designed to do exactly that. And if you Google the plunge protection team, you would learn a lot more about market manipulation, fair, quote, fair market manipulation. It's not some behind the scenes secret. They do it straight up in public. Right? So that would be a good place to go if you want to kind of wrap your head around how they do it. Quote, they. All right, so we're looking at the S&P. This is the S&P 100, and we're asking how many names in the S&P 100 are up at least 1%. 70, very close to 70, right? 65 names. So 65% of the S&P 100 is up this morning. That is a lot, right? That's that risk on sentiment that we were looking for. As we get closer to the open, we want to see if that sticks. But that's what we have for right now. So now that we know that these are the names that are up at least 1%, what industry is it? What sector is it that we want to be focusing on the most? Now we know we need finance and or technology. And since we're seeing the NASDAQ and the S&P up significantly this morning, we could lean into the idea that it's probably more tech related and less financial related, right? But if we scroll down, look at how many of these names in finance are up this morning at least 1%. And when we're focused on financials, we don't want to paint with that broad brush and just say, oh, it's financials. What kind of finance? Credit cards, lending institutions, trading firms, insurance companies. When we look at XLF, the financial sector ETF, inside of that, I really have broke that down into two groups. Bank of America, JP Morgan, and Wells Fargo is one group. Goldman, Citi, and Morgan is the other group. And those two classifications still make up the XLF ETF. So when we see all of those names up at least 1% in the pre-market, this tells us that we've got one of those two sectors. And if we have both sectors, it leans us in a little bit more to the idea that this bullish pre-market move could be sustained as we come into the open and get us until lunch. Because remember, this whole thing stops at lunch. Then we get through those additional auctions and we approach the afternoon as if it was an entirely new day. Because anything that happened through the morning session is done. And we wouldn't just automatically carry that sentiment into the afternoon. We would want to completely reevaluate the entire situation and look at what the afternoon is going to offer us. We've got energy, retail, finance, manufacturing, technology. We've got it all this morning, right? Just like I was saying, if it's going to be a bullish day, it'll be across the board. 8 out of 10, 9 out of 10 stocks are all going to be doing the same thing. It's with this logic in mind that we put together the alpha protocols, right? Now, I won't activate the protocols with 65%. It's not enough. But as we get into the open, watch the advancing versus the declining issues. Look to see that thing get pegged out at like 95, 97 names, all doing the same thing. And we call it looking for a consistent message. But, it's more of a fancy phrase. What does it look like? Well, think about what this looks like. If we can get it zoomed in, there it goes. On a day like this, what did we have? We had a lot of institutions going long and we had a lot of institutions going short. And they were basically just passing those funds back and forth to each other. This is a fair and two-sided market. But when it isn't that, and we have a very clear message and nobody's taking the other side, what does it look like? Because that's what we really want to focus on. Now, granted, this is pre-market, but it'll still fit for the discussion. Notice that everybody was going in one way. Nobody tried to buy this thing. Even these little areas where it stopped going down, it was just very minor, very small profit taking before the continuation of the move. That's a very clear example of communicating in the market. Nobody went the other way, right? The bidless beast, it just fell like a stone. And they were trying to find sellers. It's that old phrase that they say, if you're trying to buy, you'll find a million people willing to sell you something. But if you're trying to sell something, it's really hard to find a buyer when something really bad is happening. So as we come into the open, We want to look for that clear and consistent message. It's not indicators, it's not moving averages and RSIs and MACDs and Fibonacci's and any of that crazy stuff. Just look at the candles. Are they providing a clear and consistent message? Is it one-sided price action with every single firm out there all doing the exact same thing? Or is it a two-sided market where we have some going long and some going short and just causing more chop than wave? That's what I got for you guys. Be careful, be safe. I will see you all tomorrow. Oh, we had our webinar on Option Omega. You will find those in the stocks and options chat room, right? The webinar replay and then a quick video that I made after the replay. So just scroll up in stocks and options chat and you'll find those videos. We will be doing live afternoon streams where I rebuild all of the mechanical trades that I used to run and we back test them in this new market environment and start running our mechanicals again. So if you you have the time, come in and catch those. Right now I'm looking at Friday afternoon since it was a shortened week. But when we're out of the shortened weeks and we get back into regular 5-day weeks, we're looking for at least 2 afternoon streams a week where we rebuild my mechanical systems.